In 2001, Enron was America's seventh largest company, a $70 billion giant praised by Wall Street and hailed as a model of innovation. But while the world cheered, short seller Jim Chanos was betting it would collapse. Chanos set on his path to Enron in late 2000 after reading a Wall Street Journal piece about aggressive accounting in energy trading. The key term jumped out: mark-to-market accounting, a method Chanos knew could be abused to create fake profits. Instead of focusing on headline earnings, he asked a basic question: how does Enron actually make money? The more he studied the financials, the less sense they made. The filings were full of jargon, footnotes, and references to mysterious partnerships. But one number cut through the confusion: return on invested capital, ROIC. Enron, despite its sky-high valuation, was earning a pre-tax ROIC of just 7%. Its cost of capital was closer to 9%, so if the core business wasn't profitable, how was Enron reporting incredible earnings? The answer? Mark-to-market accounting. Enron had received special SEC permission in 1992 to use this method, rare for a non-financial company. It allowed Enron to book the entire estimated profit of a long-term contract on the day it was signed, even if no cash had been earned. Enron applied this to complex energy deals and speculative ventures like broadband, effectively estimating future profits and calling them real. This created a huge gap between reported earnings and actual cash flow, another major red flag. Meanwhile, to hide the real losses, CFO Andrew Fastow set up thousands of off-balance sheet shell companies called SPEs, which bought Enron's failing assets and took on the associated debt, keeping it off Enron's books. It was a way to hide billions in debt, and the footnotes describing these structures were so cryptic that most analysts ignored them entirely. Chanos didn't. To him, the picture was clear. Low returns proved the business didn't work. Mark-to-market created fake profits, and SPEs hid the debt needed to sustain the illusion. Then came the behavioral clues: high executive turnover and massive insider selling. While the public was told to buy, insiders were cashing out. On August 14, 2001, CEO Jeffrey Skilling abruptly resigned only 6 months into the job. To Chanos, this was the captain abandoning the ship. He doubled down on his short. In October 2001, Enron announced huge losses and a $1.2 billion write-down tied to Fastow's partnerships. The SEC launched an investigation. Credit rating agencies cut its debt to junk. Confidence evaporated. On December 2, 2001, Enron filed for bankruptcy. Its stock, once over $90 a share, became worthless, destroying $60 billion in market value.